All right, guys, this is being recorded. So one thing I say at the beginning of all of these is please go back and watch this again, especially if this is a new strategy to you. What will happen is it'll put it into your long-term memory the second time you watch it. First time you watch it, you kind of will miss some of the nuances of it, but after you watch it again, it will really help this sink in, some of the different rules that I go by. And this is going to be on short straddles this week. Couple of things to go over real quick. My name's Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on economic, geopolitical, and market analysis. I've been doing it in my own trading for over 20 years now, and I'm not here to tell you that I'm going to make you rich or make you a millionaire, but I am here to help you take control of your finances, manage your portfolio, and most importantly, taking control of your own risk. If you got somebody else out there doing it for you, they're charging you a lot of money and fees and everything else, and you might as well take that first step to start doing it yourself as far as I'm concerned. You're going to make mistakes, but they make the same mistakes as well, so you're no worse off at the end of the day. And I've traded most markets throughout my career. Traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products, and in most market conditions. I do have a disclaimer I have to go over. This basically is saying any opinions, news, research, and analysis or other material provided here by ProTrader Strategies and or associate companies or employees is for general commentary and should not constitute investment advice or solicitation to buy or sell any of these securities or strategies. Anyway, basically what this is getting into is I don't know your guys' risk parameters and I don't know what's in your portfolios. So some of the things that we're talking about could exceed your risk parameters or be counterintuitive to some of the things that you already have in your portfolio. So we're here to teach you some different strategies, and I urge you to implement them into your portfolios, but make sure that it's appropriate for you, is all that comes down to really. And at the end of the day, do your own homework. Please remember that past performance of any trading system or methodology is not indicative of future results. And one side note is please keep in mind that full disclosure, I probably have some of these different securities in my portfolio, and I'm not trying to do it to get you to jump off a cliff with me. It's basically, you know, it's what I see as a good trade. So I'm going to talk about it. All right. So how do we use how we use straddles to generate income? This is what we're going to be talking about. You know, if you're buying a straddle, you really need a very quick and violent move if you are going to make money with it. But we're going to be using straddles to generate income by selling these straddles, and we're going to be wanting to have this straddle be in a neutral to sideways market. High implied volatility. We want everything to come out of it right away and trend sideways for all intents and purposes. So this is, like I said, is going to be on the short straddle. Some of the keys or essentials to success in this, I have picking the right strike, but what I'm meaning by this, even though you're picking the at the money strike for the straddle, you want to make sure that your deltas are relatively neutral and that they offset. So we would want like a 50 call delta and a 50 put delta, so they kind of negate each other in a sense. You wouldn't want it to be really skewed, and some of the ones that aren't traded very often or have low implied volatility, sometimes you'll see those get skewed a little. And we want to pick the right duration. What's the right duration? In my eyes, taking advantage of basically 45 days or as close as to this 45 days to 35 days that you can get into this strategy, because what we're going to see is a lot of theta decay happening out of these options, and this is the Sisyphean task of the buyer of options, is trying to fight this decay. And I'd much rather roll the rock down the hill than up the hill. And that's kind of the way I look at when you're selling strategies and collecting a premium. You see this decay come out of these really quickly rather than trying to fight it and have the move outpace this decay. So this is what we are looking for. And when volatility comes out of this, so when we're looking at high implied volatility underlyings, the idea is that it has really high implied volatility already, and it should revert back to the mean, or implied volatility is overstated at the time that we're implementing this. And when it contracts, it allows theta to come out, the time decay to come out really quickly, and you'll see those premiums deflate rather fast. So that's what we're looking for, to generate that income. We want this to stay sideways, volatility to come out, and have that theta decay work in our favor. And picking the right environment. I've touched on this before. For stocks, we want implied volatility percent to be above 50. And I'll show you how you can figure that all out and where to find that on the options grid. For ETFs, I go a little bit lower because it's a basket of several different underlyings, and that smooths out the volatility a little bit. So for ETFs, I make that limit right around 30. I will show you ways to bend that rule a little bit to work in your favor, which isn't a bad thing at some points, and I'll show you when. Picking the right underlying. We want a lot of volume and open interest in this. The reason being is if you have a wide bid-ask spread, you have to give up a lot of edge to get into this trade, and you have to give up a lot of edge to get out. And when we're not talking pennies and nickels here. Sometimes you're looking, some people look at dollar wide bid ask. I would never go into anything that really has a dollar bid ask unless it's something like Chipotle or Priceline or something like that, the astronomical side of stock prices. But for the most part, if it's under $100 underlying, I'm looking at it needs to be at least 10 cents or less than 10 cents wide for the most part. It goes above that, I'll bend that rule a little bit, but that's what we're looking for high volume and open interest. That is picking the right underlying when they have high volume and open interest. And know your exit strategy before entering this trade. This is very important. Some people look at options and buying and selling them and just riding them to the bitter end. I don't do that. I look to take my profits as quickly as I can. And for most strategies, I say 50% of my max profit is where I'm going to exit any given option strategy. If you watch many of my webinars, you know I beat that into the ground. Don't ride this all the way out. The probabilities, work the probabilities, and you will be successful. So 50% of my max profit is usually where I'm pulling the ripcord and getting out of anything. With the short straddle, it's really hard to nail the numbers. So with this strategy, I'm looking at usually getting 30% of my max profit, and I'm getting out. It doesn't sound like you're taking a lot of profit on this, but remember, when you're doing a straddle, straddle is the one that generates the most income right away. So if I can get a quick hit on this for 30% of my max profit when I've collected $3, collecting $1 is quite nice. And something I look at in that timeline is if I can, one thing with the straddle is you're never really going to achieve maximum profit, right? Because one of your legs is going to be either slightly in the money or slightly out of the money. It's never going to, if you sell the 50 straddle, there's almost no chance that at expiration, at the end of the expiration cycle of that strategy, that it's trading it at exactly 50. So something's going to be slightly in the money. So you're never going to really achieve 100% of your max profit. And in that regard, when I look to exit or defend, if I'm, I don't know why I have defend, but this is when I'm looking to exit. Trade days in the trade, I'm looking at 10% of my max profit. If I'm in this less than 10 days and I've got 10%, it's going to be hard pressed for me to not really take the profit. At 15 days, if I'm, above 20% of max profit, I'm going to take that and run. 25 days in and I'm above 30% of my max profit, I'm taking that money. So, you know, if you see 10 days in and you're at like 15, 20% already, I would take that off, just because you've beaten the odds at that point, and any profit is better than no profit in my eyes. And you know, these markets move, right? So get out while the getting's good, I guess. So max profit on this. Anytime you are selling a strategy, your max profit is the net premium you received, minus your commissions, of course. And keep in mind, I'm never looking to take that max profit, especially on the straddle. I am looking to take about 30% of that. And it takes a little time for the straddle to decay also, because you're usually dealing with the at the money strikes, which take a little bit longer to decay. That's another reason why that one straddle diagram that I showed you is very important. So you guys might want to jot this down. Anything over 10% of max profit in 10 days, I'm taking it over, right? And your max loss is unlimited because this is a naked strategy. Now, I've talked about this before in other webinars when dealing with this. If you are in an IRA or you don't like the unlimited aspect of it, the way to mimic this straddle in an IRA is to buy like the first further out of the money strike for a nickel, and that kind of bypasses those rules. It will still act the same, but and you will have limited upside risk, but believe me, it really does not feel like you have limited upside risk when you buy that first strike that's only for a nickel, because that's usually going to be pretty far away from where you are. But it will make it IRA acceptable, I guess. And the break even is going to be your underlying price when it's equal, when the underlying price is equal to the short call that you have plus the net premium you receive. But remember, it can't go, the short call can't go to a break even at the same time the short put goes to break even, right? Because it's directional. It's either going to go up or it's going to go down. So you have two break evens, the same way with the max loss. It's your short put minus the net premium received. So you had the 50 straddle on, you collected $3 for that. Your break even on the upside is $53. Anything above that $53, you're starting to incur your losses. And when you're at the 50 strike and you collected $3, as soon as it goes $47 is your break even. Anything below that, you're starting to incur losses. One exit strategy I didn't touch on yet was my max loss. I'm usually looking at 2 times the credit received. So if it were trading at $43, something along those lines, $44, that's where I'm going to be looking to exit this and take my losses. But remember, you know, there's probability of touching your break evens, and I'll go into that here in a minute once I pull up this trading platform. So let's go into the options grid here and talk about the probabilities that I just kind of mentioned. That's hard. Let's just go into something that I don't have. Got Harley Davidson on for a Steve Primo webinar that we're going to be doing, so you guys should keep your eyes out for that too. So XOP is an ETF. We have right there at that 30% IV. 28 days, I would probably venture to the 56 days on this because that's closest to the 45 days that I was talking about. But if we're going to be doing this straddle, so let's look at the deltas and the gammas and stuff like that. So this is what I was talking about with the deltas. You can see if we were doing the at the money, the 35s, it's pretty close to, splitting hairs between being, between 35 and the 36 strike. But if you look at this, the 36 strike, the deltas are closer in comparison than you would have with the 35 strike. You got the puts as being 45 delta and 55 delta. So since we're selling this strategy, this delta is actually negative, and then this delta is actually positive, because it's kind of like, you're doing a negative, so two negatives equal to a positive, and a negative and a positive equals a negative, right? This is toss, think or swim, which is through TD Ameritrade. Somebody's asking me what platform this is. Okay, so I would probably lean towards this, unless, I was more bearish on oil. That would be a way to get more negative deltas, because you're selling a call, which is negative to the delta. So if you were a little bit more bearish than neutral, or, bearish to neutral, then you could play with selling the more delta negative. Of course, if you're more bearish to neutral on the 36 strike, your position would actually be slightly bullish. So keep that in mind when you're looking at these and you're selling these strategies. Your deltas are very important. This is going to be more, selling this straddle is going to be more bearish than selling one strike above that, okay? So keep that in mind with your deltas, you guys, because that's pretty important. So if you have an idea as to, or an inclination as it being more bearish, then I would probably lean towards this one versus this one. Does that make sense? And then, of course, if we sold this straddle right here, we would get $2.55 plus the $2 and let's say 90 cents, just to make math a little bit easier, and that would give us a total of $4.45, right? So $4.45 subtracted by this 36 is where our break even is to the downside, and then we add that $4.45 to the to the 36 strike, and that puts our break even above this 40. This was what I was talking about. If you're in an IRA, you go way out here and buy that first option you can get for a nickel. You might even bid for these 46s for a nickel. Let's see if you get them, and buy that first one for a nickel. That makes it IRA appropriate, meets the rules of an IRA, because you're limiting your risk to the upside. I don't believe that they limit your risk to the downside, which is a little odd on anything, but they do always worry about limiting your risk to the upside in those. And in that case, if they made you do the puts and it wasn't accepting, you'd go down and buy the first one for a nickel there too. Does that make sense for everybody so far on how to set this up? All right, so go in. Good. Okay, thanks. Go in, and on the questions box, you guys can start throwing out some different underlines, and I'll take a look at them and see if they start fitting the rules of different trades that I'm looking at. One thing that I have in here that is the blue, and this is where you look for that probability, or sorry, IV percentile. This is where I'm talking about 30%. That's also very important to me, and in my watch list I throw it over here. You can hit the gearbox and search it on Thinkorswim, but that is how I figure out my trades right off the bat. As I look here and see who has high implied volatility percent. Obviously there's a lot of people with earnings. I don't like really doing this strategy around earnings necessarily, because I'm looking for longer duration, so I want something that's clean. And in that regard, we're kind of limited. Nick is asking for Goldman Sachs. Is the first one I saw, 19, so Goldman Sachs would not make the cut, and they also have the earnings coming out on the 19th. Wait, they had their earnings out on the 19th. So Goldman Sachs has already come off quite a bit. One thing before I move on to the next couple of people that are throwing stuff out, what I'm talking about with, sometimes you can bend the rule a little bit on this. For instance, back in August when we had that massive sell-off, volatility went through the roof on most things. So what I have been known to do is kind of smooth it out just a little bit if there's something crazy where you get one massive spike and it really throws off the math. The way that that ID percent is generated is you have a math problem on the numerator and a denominator, right, on the division table. On the numerator, which is on the top, you take where the current IV is, say 23 or 22, and subtract that by the low, which is 5, and then on the denominator, you take the high minus the low. Well, if there's a massive spike in there that really throws everything off, you can adjust that and say that maybe 78 is the real high minus the low, and then divide those two sums by each other, and that's how you get your IV percent. So you don't always have to go straight to this and say, okay, that's the IV percent and it is what it is. You could do a little investigating and see if there was this crazy spike out of the blue that wasn't necessarily around a binary event, which is the earnings. You'll usually see big spikes around the earnings. I'm not sure why they might have come out with some kind of news here on that spike, but in most cases, it's going to want to rally into that binary event and then come off. That's why I like the earnings trade so much, is you get that volatility crush afterwards. But that's how you come up with the math. It's where it's trading now minus the low on the numerator. That sum is divided by the sum of the high minus the low. And that gives you your percent. Does that make sense to everybody? All right, Netflix is the next one I've been asked about. Check it out. They just had their earnings and got slammed on it. I don't have anything in here because I just did that as an earnings thing. 24, so that doesn't really meet the parameters. And then I would look at this to see if I can find a little wiggle room in there for that percent to make it work. And I would say no. We got that big spike in August. It has a tendency to want to spike up there. It spiked up there for that earnings. It actually started trailing off heading into the last earnings, which most things are. I'm actually seeing the lowest implied volatility percent I've probably ever seen for some of these stocks that are having their earnings events. I mean, I think even GM was at like single-digit IV percent heading into their earnings number, which is just unheard of. What do you think of using right before earnings on a stock that has high implied volatility at earnings, such as Apple, Amazon? That is, buy it at high IV and quickly sell it when IV collapses after earnings. Well, if you're saying buy this strategy, you would never want to buy this strategy in a high implied volatility environment, and then especially on an earnings, because even if that doesn't move, that implied volatility coming out is going to suck all the premium out. There could be a strong case for selling straddles in these earnings that we've been getting. I don't like to sell the straddles in earnings. It's just a lot of times you get big moves in those, and I don't like to have that naked that close to at the money. But a lot of them have been inside the market maker move, which has been pretty quiet for the most part. They haven't been moving, just like I think GM didn't move very much and a couple other ones, but that would be the only time, is if it basically flatlined right after and you sold this strategy right before, you would make a good penny if it didn't move and you got all the implied volatility coming out of it and theta all at once, yes. But having said that, big movers like Amazon and Apple, I probably wouldn't. I'd probably try and play that around something that doesn't move a lot, which is what you're really gearing for with this strategy. You don't want to, oh, you meant sell. Okay, yeah. Sorry, John. Yeah, sell around those. I love selling premium around earnings. And if you watch any of my daily market commentaries or any of these webinars, I love earnings season. So just because you're guaranteed to get this volatility crush happen right after these earnings events, you can just see it boom, and there's just so much premium sucked out of those. And if you do it, if you can find one that is in the weeklies, like Amazon, Apple, those big high flyers, then you will get a lot of premium for those and the volatility crush right afterwards. So definitely you can go back and check those out, John. I've done several webinars on earnings specific strategies. So and Google, yes, Google was another earnings trade that I actually just talked about today and yesterday in the daily market commentary. It stayed inside its market maker move, especially on the open. Surprising they came out with good earnings, but look at that volatility crush. Just today, it just fell out of bed, and it barely met my parameters of being basically, above 50 IV% when you do the math. But today, it just got crushed. So I'm sure it's in the teens. Yeah, 11. So we wouldn't want to sell this strategy around that necessarily. Just because you're not going to get any premium. And the problem with this is you can, something like Google, because it's such a high-priced stock, you can go down here. I mean, I'm saying you're not going to get any premium for it, but you will. I mean, Google is going to give you a lot of premium for this, right? But what happens in this situation when you're selling IV% in the teens, right? The likelihood is going to revert back to the mean, which means it's going to start increasing. Anything happens in here, any kind of shakeup with Alphabet, you're going to see IV increase. So even if it doesn't move very much, or it doesn't move outside your $45 that you collected for this strategy, that gives you $45 to the upside, $45 to the downside, right, to stay within your break even. If volatility starts expanding on you, then these premiums start going up because of volatility. And we could go sideways, and if volatility goes up, these premiums are going to increase. So you could be directionally right, meaning sideways, but as volatility goes up, you're going to start getting beat up on it because, fear in the market's increasing those premiums. So it might not move. That's why it's really important so for instance, here we can go up to this on TOS, and they do this theoretical price. And Mark, let's go to, you can figure out the breakdown. Let's hit reset to get it to date. Okay, so let's just say the stock doesn't move at all, but in 2 weeks time goes by, so you're getting theta decay coming out of this. You're getting these to decay quite a bit. As you can see here, so you would, these premiums would come off quite a bit from 21.20, so you lose $1 there, and it loses about $1 here. So you'd gain $2 in premium on that in a couple of weeks. But what happens if volatility increases? Like we just saw volatility yesterday in this at least 50%. Let's just say it goes up by 20%. Look at that. Goes from just 11 IV% to 20 percentage points increased. Look at that. It doubled. and it didn't go anywhere. The price didn't go anywhere. We went for 2 weeks, and just volatility increases on you. That's why it's super important to do this when IV is high. So for instance, a couple of people are trying to throw out a couple of other. Does the IV collapse usually come at a price shift at earnings? Usually IV increases because of fear in the market or something wanting to happen, and then IV decreases because that fear comes out. So that's the way I look at implied volatility, is that's kind of the fear indicator of what's going on. What other criteria do I look for in a stock other than high IV? Do you look at the stock chart, other indicators, etc.? Great question, Ron. The very first thing, the number one thing I look at for any strategy before I decide what strategy I'm going to do, I don't even look at what the stock is. I don't care. Most of these are well-traded stocks over here on the side of my watch list, and if they don't meet, you know, like that bid at, like this is a high flyer, so you can't really look at Google and say, all right, well, it's $1 wide, I'm not going to get it. I mean, it's a $700 stock, and you'll have $20 stocks have dollar wide bid ask. That's where I'm not going to do $1. But with to regards to Ron's questions, I look at high IV very first, then I go to the charts. I do look at the charts. I like to look at something, especially for this, that's been trending sideways. You know, I would like this back and forth action, but staying sideways. And then something else, I do look at the Fibonacci's. I like the candlesticks. The reason why I don't necessarily believe everything about Fibonacci with, you know, there's 66 point some odd petals on a flower, and therefore it's a reoccurring number in the environment, and that makes the stars align and all that stuff. I look at it like, hey, there's so many people that look at this particular strategy. They are going to look at it like they're going to defend those lines in the sand. So I look at it in regards to that. So yes, I do look at those, but it's not the end-all be-all of mine. It may solidify, you know, maybe I've got something with over here, it's in the 45 IV percent or a 44 IV percent, something that's bending that rule, but man, it is landing right in between this Fibonacci level and this Fibonacci level. It's right in between there. If I can get above that Fibonacci level or get my break even to go above and below those, then yeah, I'll start bending this rule a little bit more. So I do look at those kind of things. It's usually Fibonacci for the most part. I do look at, you know, the moving averages and stuff like that. The RSI, things of that nature, but those are just kind of like, and as you can see, the MACD, but those are things that are side issues that I might start looking at those because I really want to put a trade on at something and it's not meeting one of my rules. I'll throw the fibs on it. So as a matter of fact, I think I have them on Apple. So let's just look at Apple for right now. Because I actually did this with a trade in Apple, and I just took off my Apple trade for those people that were following me on these market commentaries. I when long the 100 puts, but it was because it came down and broke through this area here when we traded down. And I also look at market profile and the monkey bars over here. This is another thing I like to look at because this is psychology of the market, just like the fibs are. You know, I mean, there's so many people out there, it brings it to fruition, even if it's not a reoccurring thing in nature or whatever. But I do look at those levels just because I know so many other people do. And this tells me where people are putting their money where their mouth is, because this is the most volume and time has been spent in Apple right here. This is where the most people find value for Apple. Right there, $10 or $110.60 ish. So that's where people are putting their money where their mouth is. $111, let's say. So it's going to want to migrate there because people believe that's where value is. So it gets above it and below it, it's going to want to push back and forth, you know. Obviously, it spent some time down here, but that's people were scooping it up for that rally. It came right back to point of control. So I do look at all those things, but that's not the end-all, be-all of everything. So I just kind of look at it as if everybody else is looking at it, I probably should look at it too, because it's going to come. They're going to make it happen because they believe it to happen. Does that make sense, Ron? Great question. Nick's asking, if the stock starts going in the money, which it will, how far out do you go before you start to roll it? With this strategy, I will wait till it starts to go to, if I change my idea, now let's go back to this again. So when we're talking about Apple, just as an example, and it doesn't have high implied volatility, as you can see here. So this wouldn't necessarily make it. So let's go to one that does. So SLV, we all know it's been a bit crazy lately. Oh, and I got all my puts there because I think actually to answer your question, I think it was going to cover this gap. That's something else that I was looking at. I think SLV is going to cover this gap. So that's why I bought those puts. You know, that's something else I look at for gaps and stuff like that. Let's do JDXJ. I know that's pretty clean. And this is the junior gold miners ETF of GDX kind of. So we'll look at this because I think it has, yeah, high implied volatility. All of my miners right now are having high implied volatility. Let's scratch this, go back to the delta and the gamma to try and get it as close to even as we can. It looks like it's 34 is going to be the closest to even on the delta aspect of it. You know, again, if I was a little bit more bearish on GDX, I might go down to the 33 strike, which I am a little bit more bearish right now on gold just because it's had the big move up as a contrarian, I guess, if you will. But for let's just say to get our deltas neutral, we would want to sell the 34 strike. So we're going to sell the 34 calls and the 34 puts. And that would put us at $5.10, right? Did I do the math there right? $5.10. So $5.10 to the upside. So that gets my break even just above 39 and to the downside 29, right? So think about this. If we sold this 34 strike and 39 is our break even, the probability of it going up here and touching 39 is 2 times the delta. And that's just like a ballpark. I don't know that there's any real math involved in that, but I can tell you it's pretty darn close just from trading over the years, that you have a probability of it coming up and touching this is 2 times the delta. So there's about a 50% chance that it's going to trade up there and hit that, or to the downside, about a 40% chance of it coming down and testing you on this side. So your break evens, you can all basically say your break even is going to be a 50-50 chance of getting tested on your wings. Now I talked about doing 2 times that, so the $5, the upside is $10, so we're looking at the 44s. Your probability of getting tested on you wanting to really get out of this trade is 20%, because it's 2 times that. So keep that in mind when you're doing your probabilities of this happening, and 10% probability of this. So if it really started selling off, then I might be more likely, because this is a more rare instance. If a 50-50 probability, I can deal with that. That's not too bad to swallow. But when you start getting up into your probability of being tested on your on your puke out, I guess, if you will, for lack of a better word, is 20%. You know, I mean, that is a pretty high probability of getting tested, I suppose. But you know, this 10% down on this side, this is probably where I would just get out of this trade. Now on this side, having said that, or roll, you know, that, but I would roll to about the 20 deltas, the 16 deltas in that regard. So it would have, if we were trading up in here around this, I would roll my puts because they aren't worth anything anymore. You know, they're going to be a nickel to a quarter. So that's, you basically sucked out all the premium of those. And I would roll it to where the now 16 delta would be. Try and collect another 60 cents, is 50 cents or something. Just to, you know, keep the dream alive and hope it comes back a little bit. But when you roll to defend a straddle, you're pretty much basically throwing in the towel on it. At the end of the day, I look at the straddle as I'm going to cover it when I'm 2 times my credit received, and I am going to let it test me. But I'm going to dump it when it hits my 2 times. It's just really hard to defend a straddle. Strangles are a lot easier to defend, and because you can roll to make it into a straddle. But with the straddle, it's just very hard to defend. It doesn't usually work out. It's going to usually just stay against you once you've gone 2 times for the most part. Does that answer your guys' question there? Probability of touch over life of options versus probability of touch, say half the life of the option. Would that be different? Great question. I've never really thought about it that way. I just know when you're entering the trade and those deltas, that's kind of what you're looking at for your probability of touch. And that is over the life of the trade, yes. Over the life, you know, to expiration. But I'm looking at this, like I said, get out 30%. So, you know, if I'm getting $5, 30% of that is what, like $1.25 or something like that. Is that right? 3, 5. It's close. So really, it's closer to $1.75, isn't it? $1. Anyway. Don't have my calculator. I need my calculator for that one. Somebody else can hit that up. But, you know, so taking out $1 something in this strategy going into it. Yeah, it'd be about $1.60, right? Okay, so that's what I'm looking for that. So, and I have a notebook where I write everything down. I write my trades down when I get into them, why I kind of thought about getting in them, and then I also throw in there, you know, when I'm looking to get out. So, you know, put that down on paper. So the reason why I do that is because then I get out, I wrote it down. That was my idea, to get into the trade, where I was getting out. And I try and stick by that. I try not to let other influences that happen throughout the time get me out of that, unless it's like a news event or something like that where, you know, OPEC all of a sudden decides to shut off the spigot because Iran came to the table, which I don't see happening either. So I don't see gold as being able to, or oil being able to sustain the levels it's at, but that's just my soapbox. So that's the straddle. You guys have any more questions or have any other thing that you want me to look at for this strategy, or did I breeze over anything that you guys want me to nail down on? So I'll go over a couple other ones. The JDXJ is one that I was going to look at. Joy was one Joy Global was one that I was looking to bend some of the rules on. I think it had a little bit tighter. It has a tendency to have tighter markets a lot of times. Maybe it's in the 9 cents wide for a 10 cent. It's less than 10 cents. I probably worked this to see if I could get in, but it had a couple of big spikes. I was thinking this wasn't the one I was thinking of, that I could discount one of the big spikes on it and make it work, because it's got 43. I think it was trading a little bit 45. It's come off a little bit, but Joy Global is one that has had earnings, doesn't have earnings in this next expiration cycle that I could take advantage of. But I'll probably be looking to put on the junior gold miners, and XOP was the other one that I was kind of looking at. So XOP, that I have a strangle on. I did that one for the last week's webinar. And so going closest to the 45 days here, we'd be looking at trying to make our deltas relatively neutral. If you're more bearish in oil, like I just said I'd probably lean towards doing the 35 strike here. So let's just say that I am slightly neutral to bearish. And so hold down the control button after you've hit the first one, lock that down, and you can do this. $4.42 for this one. As you can see, your buying power effect is only going to go down by $700 for the one lot, and your max profit is $440. So that's pretty good risk return. But again, remember, I'm only going to be looking at taking a dollar something out of this, so $1.50-ish out of this, maybe $1.75, something like that, before I cover that. Does that make sense to everybody? So I'm going to look at putting on XOP for this webinar on Monday, and GDX. So I've started both of those. So you can look for that in the daily market commentaries. Does anybody else have any other questions, or have something enlarged screen to see? What did you want to see this down here? I'm not very good at zooming and stuff. All right. Can one sell straddle on weekly options? Absolutely, for sure. And if you wanted to do something, and one of the let's say somebody who I don't know exactly when everybody's earnings are right offhand, but let's just say it was when it's theirs. It's got 46. One way you can tell when their earnings are is you just look at the options chain. You can go right down the line and see when it increases the most and then starts decreasing. So I could tell you this is the cycle where CSCO has its earnings in May. So we can go like this and look right at the end of May. This option goes off, so it's in the last week of that monthly. So if you wanted to really do a trade in here and it's trading sideways, try and take advantage of it and hope that implied volatility doesn't ramp up going into that earnings very much, which we aren't really seeing right now. So one could make an argument that it's not going to increase that much. Pick the one right before that earnings event. And Cisco has tight bid ask. I mean, $28 wide or $28 stock. It's got $4 or 4 cent wide markets. So yeah, you could totally go into this. Just make sure that it has a lot of volume and open interest going in there. I mean, it doesn't have a lot of volume going on, but the monthlies do, especially in Cisco. There's always players in there, and that's a lot of open interest. So there's players in there looking to get in and out on any given day. So I would definitely say this is one that would meet that, where you could sell this as a straddle. Plus, it's got pretty tight bid ask. Just make sure you go mid-market or a little higher, and then start. If you guys are traders that put it in an order all the time and it gets filled immediately, you're doing something wrong in my eyes. Put it in a little bit higher than you think you can get filled, because you never know, and then just slowly work it out. Cancel, replace, cancel, replace, cancel, replace, and move it down, you know, every like minute or so. Markets aren't moving that fast. You know, sometimes I do ask myself, do I want the penny? Do I want the trade? And that's when I'm going to give it up, because I want the trade right now. But make that decision that way. Put it in a little high, and then ask yourself, do I want the penny or do I want the trade? And that should determine how fast you start moving ratchet those down. So yeah, definitely you can use the weeklies with this strategy. It will work out as long as there's players in there. Now, don't do something like, I don't know, somebody offhand that, you know, I don't think ABC has very good markets. They don't have weeklies either, but see, this is a $100 stock, and look, you've got 25-cent wide markets. Probably would not be going into that 40-cent wide markets, and they don't have weeklies. Most of the guys that have weeklies have a lot of open interest and volume. That's why there's so much demand for it that they can put those options in there. I was just trying to think of somebody who doesn't have. And one thing to note, you know, like with some of the ones with really cheap stocks, you know, for Hertz or something like that, you know, they do have an event. But one thing with these cheap ones like this that I stay away from doing this straddle or strategy with is because, you know, the downside is almost not even there. So it's like, why am I even selling the calls for that matter? I stay away from these like single digit ones for this strategy also. Yeah, I'll look at IBM real quick before we start wrapping it up. So IBM, 16% again. So, you know, immediately I'm not going to do it. I can look at the charts. They just had their earnings. We just had that volatility crush. You know, maybe in this cycle, if we start seeing some vol increase, I would play around with it. But at this point, I would stay away from it just because they just had their earnings. So the real thing I would be looking at right now are the ETFs. Does that make sense? What is an IV percentile as opposed to the IV? Well, the IV is where it is right now, and the percent is where the IV is now in relation to where it has been. You know, historical volatility is completely different to that. But this is basically a ratio as where it's trading here in regards to its high and its low. So when it's low, it's basically saying it's near its low, and when it's at 100%, it's saying it is at its high. It's not saying that it can't go higher than 100%, because keep in mind, if current IV is right here right now, then that is 100%, right? Because it is, even though it's saying 99.77, it's still 100% of where it's been. And it upticks, guess what? It's still 100%. So it can't go higher than 100%, and it can't go lower really than, it can't go to negatives either. It can go to 0 and keep going 0, 0, 0. But just keep in mind, implied volatility can continue to expand even though you're at 100%. But our thinking in this is it's going to revert to the mean. It's going to revert back. Like in this situation here would have been a good time to get into IBM when you've seen it ramp up. Now, not to say that you wouldn't have gotten into it right at this level and you saw IV go against you a little bit. That's, you know, going to happen sometimes. But you know, when you see those moves, getting in when there's a high implied volatility, because even though this started moving, you could see that the implied volatility really happened fast, and you might have been able to get out of that relatively quickly. You know, within a day or so, you could have gotten 10% of your max profit right away within 2 or 3 days, maybe even a day, when you get that volatility coming out. Does that make sense? What is the green dotted line on the chart? That is this right here. That is the, that is a good question. That is the, what is it? See, I don't even really pay attention to all of that. Monkey bars. Oh, the daily SMA. I think that's what, yeah, it's the daily SMA. Simple moving average. And that's actually something I'm looking at to for Steve Primo's strategy number 4 that we're going to be doing a webinar on next Saturday. Not this Saturday, but next Saturday. But yeah, see, I mean, I have a lot of these things on the charts. I don't look at those necessarily as the end-all be-all to put on a trade. I put them on there because I know a lot of people look at those, and you know, that helps trades come to fruition. I don't even know what they are. I just know when they cross, that means it's either going to be more bullish or more bearish, and people are going to look at that and have a tendency to push it that way. So that's why I look at those things. All right, that's all I got for you guys today, other than, you know, we do have this trial membership for $7. Basically, you get my daily market commentaries where I talk about geopolitical market analysis, talked about all the oil stuff and the Brazilian impeachment stuff. You know, I talk about all that and how it's going to affect the markets, or how I see it affecting the markets. And then I talk about my trades that I'm putting on. I talk about when I put them on. I talk about when I'm defending them, when I'm covering them, what percent of profit I took, all that stuff, and go through all of those details rather quickly. I mean, they're only 5 to 10 minutes long. I try to keep it under 10 minutes, but if you guys know me from any of these, I have a tendency to ramble and chat. So, but I try to give you as much information as I can, and I talk about the different economic releases. Then you also have the trading lessons, which is like 10-15 minute on these different strategies, just kind of as a refresher if you wanted to not watch the hour-long workshop some 6 months down the road or anything. And what is the URL for this promo? It should be in the chat box there. If you click on the chat box, there should be a link there. Yeah, there's a link in there to this. John, thanks for asking. And then we're also doing live trading workshops, which is what this is. And we go into the details of all of these different strategies that you can do. And I basically walk through step by step what I go through to figure out what kind of strategy I want and what underlying I'm going to pick. And I love your guys' intake back and forth because it makes it real. You know, like looking at IBM. Yeah, well, IBM looks like a pretty good candidate, but you know, the IV percent's lower, and I wouldn't want that to expand on me. So it really makes it work out pretty well to have the back and forth. Also, it just makes it more fun for me and for you, hopefully. And so you can click on that in the chat box. I see it there, so it looks like it's still there. And in future webinars, like I said, we're going to be drilling down on different options trades and options strategies when and where I find them appropriate. This is also the URL for that special offer, but it's probably easier just to click on the chat box link there. And one other thing that I didn't mention with the workshops and the premium trial and or membership you guys have a strategy that's going against you, or if you want me to look at a particular stock or ETF or something that you're thinking about implementing and want to know what my rules are around that or how I would defend that, I can only tell you how I would do it. I can't tell you how I think you should. The reason why is because, you know, I went over that in the very beginning. I don't know your risk parameters. I don't know what's in your portfolio. We'd have to spend a lot of time going through your portfolio, what trades you've done, what your risk tolerance is, and all of that stuff. But I can tell you how I would treat a particular strategy, how I would do a defense on a strategy, things of that nature. So please reach out to me if you are at all nervous, because you know, that's the worst, is when you're just trying to beat yourself over the head and figure out what you're going to do. Reach out to me. We can bang it back and forth and figure something out. Also, reach out to us and tell us what options, webinars you want us to do it on. You know, if you have a particular strategy that you like, you want to know what my rules are around it, and or something along those lines that we haven't covered, reach out to us, please. We're always looking to do stuff that you guys want to see. And I want to thank you guys for watching. Contact us at 310-598-6677, or you can email us at trading@protraderstrategies.com. You can use that if you want to find out what I would do in a particular situation. All right? Hope you guys all have a great weekend. Happy Earth Day to all you guys. And if you can't take that, take it easy. Take care of you guys.